Hi, and a big welcome to everyone who's joining us for this third session hosted by NPC in our Effective Philanthropy webinar series. In this session, we'll be talking about the role of impact investing in effective philanthropy. I'm Gurmeet, for those of you who don't know me, and I'm the principal for impact investing at NPC. I'll introduce and open the session with a few slides, followed by a presentation from two fabulous speakers we have from the industry. We've got Gail Cunningham, who is with us and who will be joining us from the Association of Charitable Foundations. And we have Paul Gunstenson from the Stone Family Foundation. Gail has been promoting impact investing in foundations and will talk to us about their sectoral perspective on this. Paul, on the other hand, has built an impact investing portfolio from scratch at a foundation, and he will talk to us about their thinking behind that portfolio and why did they end up where they end up. And we'll hopefully just have some time in the end for a discussion and for some Q&A. So if that's okay, I'm going to kick straight into the presentation. And before we actually talk about why impact investing makes sense for foundations, I just wanted to present sort of the continuum of what investments might look like for a foundation's perspective. Simply, we have sort of a range of participants in this discussion. And this chart basically aims to show where a foundation's assets can be used. I'm hoping a lot of you will be familiar with the items on the left, which is about using the foundation's investments for traditional investing in finance first and sustainable investing investments, where the goal is largely to maximize financial returns, irrespective of social or environmental impact. In some cases, and today we're seeing a lot more money going towards what is termed as sustainable investing, where the objective is as much to push for market rate financial returns as much as to have environmental and social sustainability. For this discussion, though, we will be focusing exclusively on the middle two segments of this continuum, which is impact investment and social investment. And the way we define impact investment, and I believe now this is an industry-wide common definition, is to look at investments which are made with the intention to generate positive, measurable social and environmental impact alongside a financial return. These investments can be across asset classes in both emerging markets, in the UK, in other developed markets, and they target a range of returns ranging from below market rate returns to market rate returns, and really depends on the investor's strategic goals around where they want to end up on this spectrum. The social investments are something which are very specifically relevant for a few markets, such as the UK as well as the US, where you can have enterprises, social businesses set up themselves as VCSEs, where they have a mission and an asset lock, and they're called social investments. Impact investment is a much broader umbrella, where the objective could be to invest in any purpose-driven company where there is a goal to make a significant social impact while looking for some sort of financial returns. Typically in the impact investment space, you will see a lot of investors coming in. So we have institutional investors who are investing in certain segments of the impact investment market. Governments are beginning to do quite a bit in impact investing, and trusts and foundation endowments as well, as Gail and Paul will talk through. Adrian, if you just move to the next slide, please. Thank you. And this is really to talk about why do we at NPC think impact investing and social investment are relevant for funders. Firstly, we wanted to make it the most important thing to remember is that impact investing and social investments are a complementary tool to grant making, where the objective is to work with impact generating organizations to achieve impact. We believe it's incredibly important to not see investing as replacing grants. We strongly believe that there are certain social issues which are best addressed by grants, while there are other issues where investments can really move the needle on innovation. We'll specifically hear from Paul from the Stone Family Foundation around their experience from investing in market-based solutions for clean water and sanitation, which is a major problem in developing countries. And it has been for decades funded through grant money from governments. However, the Stone family and many other investors in the market have looked at investing in water and sanitation solutions because they believed a market-based approach was complementary to grant making and creating further impact in that sector. And I think it's really important to think of investments in that complementary capacity and not as a substitute. The second biggest reason why we think everyone should think about impact investing is simply because it allows recycling capital, allowing for a multiplier effect in terms of potential impact one can achieve with the same level of financial commitment. Simply put, even if you're looking at a 0 to 3% rate of financial return on your impact investments, it still allows your money to go much further than it would if you were simply making grants. And we believe in today's world, where we have the cost of living crisis and where the level of need in the philanthropy sector is incredibly huge, impact investing allows for the opportunity to leverage funds in a way where more money can actually back, same amount of money can back more projects. And that's something really relevant in today's day and age. Impact investment allows for leveraging additional capital from other sources. We have seen and helped in structuring many investments in a fashion where you can get additional capital attracted to a business and sector through blending capital. Different sources of capital can come with different risk return thresholds. There are certain investors who want market rate returns, and there are other investors or foundations who are happy to have provide grant funding. And if you can mix those two in an intermediary structure, that allows you to get capital from many other sources into a certain sector where that capital might not come otherwise. And that's, again, quite an interesting approach, which one can innovate and use with impact investing, but it doesn't work very well with grants. And we believe that's another reason to explore impact investing. We believe impact investing is a very important part of answer for market-based solutions to social problems, which require investment and coordination across multiple actors. We have seen certain sectors where the impact investments have made a big difference: low-cost housing, affordable childcare, affordable schools, clean water and sanitation. These are sectors where significant funding and investment has gone in to actually create a large level of impact, which just wasn't there when impact investments were not very high. So that in itself is a good reason to sort of think about which sector your foundation is interested in and whether there is a role for market-based solutions in that. Impact investments also allow for a formal channel for inputting into governance in a way where typical grants don't. By investing in a business, it allows you an opportunity to either get involved with them at a board level or even as an investor council level, which provides an opportunity to offer engagement to them, learn from them, and also opportunities for influence to work both ways. And we believe that's quite an attractive opportunity with investments, which one often doesn't see purely with grants. And finally, it enables wider partnerships towards solving key issues. And there is an opportunity to involve different sectors in a society to promote a wider dialogue. Often we see sectors where most dialogue happens within the charities and within the social sector, which is great. But I think there is role to involve employees and communities, which can often happen through impact investments, because it just opens the room for different people with different sorts of perspectives to come in and talk about their views. Adrian, if we move to the next slide, please. So there are two different ways through which charities and funders can make impact investments or social investments. And you'll hear on this more from Gail, but I just wanted to sort of quickly lay out the lay of the land, so to speak. The first is what we'll call the program-related investments, which are very closely aligned to funders' social mission. Charity Commission has a very specific guidance around it, and I'll highly encourage everyone to go and look at it because it's a bit of a minefield. But they define a PRI as using a charity's assets directly to further its aims in a way which could also produce some financial return for the charity. And the PRIs are different from financial investments in the more specific sense, where the justification for making a PRI is actually to further the charity's aims. So these are the investments where you're directly targeting impact in the area where your charity or the foundation is focused on making an impact. So your returns are typically lower with a PRI. PRIs can take many different structures. We know of foundations who have done loans as in PRI, equity investments, revenue financing, and also investing via intermediaries or what one would call impact funds. However, different structures come with their own pros and cons. And again, it's worth thinking about a PRI in the context of your foundation's broader strategies in order to make sure you're very comfortable with the instrument you're planning to deploy, because different instruments come with different risks and returns, as one can imagine. The other part of social investments is what one would call mixed motive investments, which typically have a lower impact threshold than a PRI, but they target market rate financial returns. We have seen a large number of endowments, specifically within the UK, who are moving towards making mixed motive investments. Esme Fairburn is one of them, Tribute Trust is one of them. St. Guy's and St. Thomas have also made mixed motive investments. And the target here is very much to maintain the endowment's financial value to the extent possible by targeting market rate financial returns. However, the impact threshold is lower than a PRI, but still targeted at the foundation's overall goal. And one big point which we wanted to sort of make here is, if you just look at the evidence in the sector around financial returns from mixed motive investments, there is quite clear evidence which shows that most foundations actually end up meeting or even surpassing their financial return thresholds when they make mixed motive investments. For example, Esme Fairburn have publicly reported a 31% return annualized over a one-year period through their impact investment portfolio. Similarly, Ford Foundation in the US have generated a compound annual return of 28% compared to the 7 to 8% standard financial return one sees for perpetual foundations. Of course, these numbers are a snapshot and there are sort of financial return figures at a point in time, so they need to be sort of treated with caution. But what it does show is that there's a big concern within the industry around prioritizing impact investments and wondering if that's going to erode the value of the endowment. And we just wanted to sort of present a few data points to say that that's typically not the case. It is possible today to sort of find investments where one can make the target financial returns while also aiming for impact in your own priority sectors. Adrian, if we just move to the next slide, please. And I just wanted to sort of maybe finish our presentation, or the NPC side of presentation, by talking about two key considerations foundations need to have in mind when they think about making the transition to incorporate impact investing in their philanthropy portfolio. First of all, I think foundations need to think about it more from a strategy perspective. You need to decide the allocation in terms of how much capital you want to allocate to investments out of your endowment and what sort of risk and return that pool of capital can take. This requires an assessment of the appetite for financial risk within the foundation, your impact ambition, and also your liquidity requirements in terms of the endowment. It's also worth thinking about the state of the sector where you're looking to target the investments, because we have seen in our experience and based on what we've seen of other foundations is that nascent sectors will require more patient capital, which is then able to stay invested for much longer run and is also willing to accept lower returns. Paul will speak here about their experience investing in water and sanitation solutions for the poor in developing countries and why they chose to invest there from their PRI capital pool and not their mixed motive capital pool, simply because of the sort of state of the sector. So that is something which is an important consideration as you look at making impact investments. One reason why many foundations haven't incorporated impact investments as a big part of their portfolio is because of the operational considerations. And we just wanted to highlight some of them here. I think one of the biggest things foundations need to think about is really look at their existing governance mechanisms. Most charity boards are not often set up to think about financial returns. And similarly, most investment boards are not set up to think about impact. So I think when a foundation looks at making impact investments, they need to make sure that their board and investment committees have a mixture of skills, both in terms of being able to assess impact in investments, but also have the financial acumen to be able to say where the risk return might be appropriate for the portfolio. Capacity to do due diligence on investments is incredibly important. And again, we've seen that most foundations and charities are incredibly strong on their ability to do impact due diligence. However, the financial viability of the investments is something which needs to be considered very carefully. And that's an area where many organizations are quite keen to build up their skills. The capacity to do due diligence is also driven by the costs of due diligence, which can be quite significant depending on which structures you're looking to invest in. And again, there are many different ways one can manage those costs. We've seen different approaches work in the sector. One can look at investing via intermediaries or impact funds, where you invest your money alongside other pools of capital and you pay anywhere between 1% to 3% of your commitments towards as sort of due diligence fees and portfolio management fees, where somebody else with a financial expertise can manage the portfolio of investments for you. We've also seen foundations get together with other like-minded foundations and investors and do joint due diligence, which allows them to share learnings, but also share costs. And finally, I couldn't let this go, but sort of really mention that there's a wide advisory network which is now available in the sector to support impact investing approaches in philanthropy. At NPC in particular, we would love to talk to you if you're a funder which is looking for strategic and operational support to integrate impact investments as part of your philanthropic work. We've worked with a few family foundations around this, and we're happy to bring that expertise to you. If you're a charity which is keen on using your endowment to leverage resources from other like-minded funders for innovative social investment models, please come and talk to us. We're currently working with Rethink Mental Illness, who are putting together a catalytic first of its kind impact fund, blending public and private funding for mental health. And we would love to be able to do similar work with other charities in the sector. And finally, if you're an impact investment intermediary or a fund which is looking for an impact partner, again, please come and talk to us. We've got a significant experience in this place. We're already an impact partner to 3 UK-based impact funds, where we help them do due diligence on the impact side of their investments and also help with portfolio management. So we would love to sort of support other people in the sector who are considering similar expertise. With this, I'm now going to stop because it looks like I'm coming to the end of my allocated time for this, and I'm going to pass on the baton to Gail, who represents ACF and will talk to us a little bit about how ACF has been encouraging impact investing within their network. Over to you, Gail.
Lovely, thanks, Yumi. I'll just share my slides here. I think that'll work. There we go, hoping everybody can see that. I can see people nodding, so that's great. Hi, great to be with you today. My name is Gail Cunningham. I head up the investment learning programme at the Association of Charitable Foundations, and that includes running the Social Impact Investors Group, which is more commonly known as the SIG. Delighted to see a few of the SIG members and ACF members on the call today. So just a quick introduction. The SIG exists to support foundations who are interested in or undertaking social impact investing. There is a focus in the programme-related investment side on UK-centred opportunities, so they might be funds that invest in the UK and internationally. In the mixed motive side, it's more international, and I'll come on to that in a moment. The SIG runs a series of monthly learning sessions which range from beginner through to advanced, and we also provide a toolkit with a range of resources like template investment policies, template loan agreements, and so on. We also run bi-monthly, so every second month, market information days. These are free to attend, subject to self-certification, and you get to hear about investment opportunities from social enterprises, charities, social impact bonds, social impact funds, and so on. And they're a really great opportunity if you're new to social impact investing to come and hear what more experienced investors are asking. And then, as I mentioned, SIG is convened by the Association of Charitable Foundations, which is the membership body for UK foundations and grant makers. If you would like to learn more about ACF or the SIG, or if you'd like a copy of these slides, please do email me and I'd be very happy to provide those. So just to have another spectrum of capital, and in this world of impact investing, you will see different spectrum of capitals a lot, but they all look vaguely similar. On this, I really wanted to focus on those columns in purple. The Charity Commission has released Charities and Investment Matters, a guide for trustees, which is known as the CC14 Guidance, and it's what covers all charitable investment, including programme-related and mixed motive investing. What we're really seeing at the SIG and at ACF is two types of impact investing by foundations. What we would call impact driven, and what in the guidance is known as mixed motive investing, where, as Gurmeet said, you're trying to balance the financial return with the impact and ideally get a market rate financial return. And then impact first, or program related as the guidance calls it, impact investing, where you're happy to accept a lower financial return, potentially financial loss. You know, you might be going for 0% return plus inflation. Obviously, inflation's a bit all over the place at the moment. You might even go for less than 0% or 0% and no inflation. So you are eroding your capital. But that's in order to get higher impact investments. So to give you an example of that, Esme Fairburn Foundation are a member of the SIG and ACF. They've recently put an allocation towards impact-driven market rate return, mixed motive impact investing. They've put 10 million into that pot. And what they're really looking for there is particularly venture funds, private equity, renewable energy, some of these things that will really scale and provide market rate returns. They also have had for a number of years an impact first program related investment pot, which they aim to get between 0 and 1% plus inflation return, and which they have achieved. And they've really now been looking at that pot and saying, how can we make it even more equitable? How can we reach even more organisations with our investment? And they've been very innovative at the types of investment they're willing to do. So the data for this comes from a SIG survey that we did in early 2020, back in those pre-COVID days, looking back at 2019 and what SIG members were up to then. We are intending to do the survey again early next year, because obviously, as we all know, there's been quite a lot of change over the last few years. What's quite interesting in this is looking at the different types of investment foundations were making back in 2019. There's a big spread. Obviously blending, you've got part grant, part loan, charity bonds, community shares and crowdfunding are really interesting. We've seen Friends Provident Foundation do a lot of that. And what's really interesting is if they put 500,000 or $1 million in, they still only get one vote alongside the local community that's raising the rest of the crowdfunding. So that's quite an interesting way to play with being more equitable. See, equity investment, quasi-equity investment. We've seen a real growth in those areas, particularly through COVID, partly because it is more equitable. The organisation you're investing in doesn't need to pay you until they are making some kind of return themselves. And also obviously during COVID, where loans were really tricky to be saying, well, you owe us a loan repayment. You don't have to do that with equity. You own shares in the business. Then you've got more traditional property purchases, secured loans, typically secured on property or other assets that a charity or organisation might have, social impact bonds, and then social property funds and unsecured loans. We've also seen even more experimentation since 2019. So to use Esme again, they've just set up a perpetual bond, which is a way of doing a bond that puts more of the risk onto the foundation and less onto the organisation that's taking the investment. And so it's really looking at ways to make sure it's equitable, to make sure that you're not loading too much risk onto the social enterprise or the charity. In terms of the direct versus indirect, obviously this is a mixture. With direct investments, where you're taking equity in a business, making a loan directly to a business, as Gurmeet said, it would typically be closer to your mission. It does take a lot more time and resource. You might be shaping the investment. You'll have to do significantly more due diligence. With indirect investments, for example, a social property fund, you might get a much more diversified investment because there'll be a number of underlying investments, less time and resource to do the due diligence, but obviously likely to be somewhat less close to your mission because it's not just a specific one close to your mission. Just a couple of notes on the size of investments. As you can see, it's a big range. The average minimum investment, we do see foundations going right down to sort of £50,000 loans. Below that, it gets quite tricky in terms of the time and resource. And so what we're seeing is more specialist providers who can provide those much smaller grants and either loans or grant and loan mix, and foundations investing into those providers. At the maximum end, 2.374667 is a very specific figure, but really what you're seeing is organisations like the Church of England with their social investment pot, like Guy's and St Thomas's Foundation with their programme related pot, looking at putting 1 to 5 million in each time. And then in terms of the length, 4 years was the average length in 2019. I'd say that's probably gone up, and that would typically be a loan. And then maximum length, we were seeing 12 years. And obviously, if you're taking equity, that may well just be ongoing for a significant amount of time. To give a quick example of that, Dunhill Medical Trust have both an impact-driven mixed motive portfolio and an impact first program related carve out. So they put 10% of their portfolio into impact driven investing. They're looking to do 3 to 5 million investments each time. They do have quite a large pot. And as you can see, they're looking for a high financial return. It's a high risk area, but they're looking to getting that growth through venture funds, private equity. And what they've done to decide where to invest is they've looked at the UN Sustainable Development Goals, worked out which ones are closest to their mission, and then they're looking to invest on those themes. By contrast with their program related carve out, which they've allocated 5 million to, they're looking to do much smaller investments, only to get, 0% plus inflation to protect the value, but no more than that, primarily in the UK and very closely aligned to their mission. Staffing is always a question, resourcing and how this gets staffed. And so this is a really interesting slide from the SIG survey looking at the size of a foundation's total investment pot and therefore how they staff that. At the smaller end, so anyone who's got under 2 million as a pot, what we were seeing is that typically it would be a staff member. You may only have 1 or 2 staff members. There'll be a staff member with a grants background who can really do the impact and looking at what the impact is, but working closely with either a trustee or a co-opted volunteer who would be involved closely in the deals and who would be helping with the financial aspects of those deals. As you get higher up the scale in terms of the size of the social investment pot, you're then seeing specialist social investment managers in-house doing that work, and therefore less involvement from the trustees or any co-opted volunteers. External support is really important, and we are seeing a growth in the availability of consultants to do that support. And that might be around due diligence, it might be around legals, it might be around financial modelling. There's a whole range of external support that foundations are seeking. One final member example from me, UFI Voctec Trust, which again is a SIG member. They've actually gone to 100% impact portfolio. Though some foundations do say they have it slightly easier because obviously they are a vocational technology trust. So it is rather easier to find exciting venture private equity opportunities in the space of vocational and educational technology solutions. Again, they've used the United Nations Sustainable Development Goals and also their own mission to analyse things and see how close they are to their mission. And then they're just talking a little bit here, and you can look up UFI and Dunhill, in fact, have written a whole paper each on how they've gone about it in terms of speaking to trustees, recruiting trustees with expertise, dealing with their existing investment manager. And that's quite interesting. What we often see foundations doing is on the mixed motive piece where they are looking for financial returns, they're doing it alongside either their existing investment manager advisor or an mainstream investment manager advisor who can do that work. On the program related side, typically we see that being staffed in-house. And what they're really looking at is how they can forward their mission through their investments. So yeah, that's it from me. I'm hoping I've kept the time properly. But if you would like a copy of the slides, or if you'd like to know more about ACF or the SIG, please do just let me know.
Thank you so much, Gail. You did keep to the time very well. And I think we really appreciate sort of hearing from you with specific examples from the ACF membership. I think it's really helpful to see how different foundations with different missions have sort of approached this and integrated. And I'm sure you'll get some questions around that. I would love to pass on the baton to Paul now to talk to us very specifically from a funder's experience of how they thought about making impact investments and how they have actually gone on the journey, and most importantly, their lessons in that process, which I think will be really interesting to sort of help bring all the perspectives into this discussion. Over to you, Paul.
Yeah, thanks, Gurmeet. If you could pop my slides up, that would be helpful. So I'm Paul Gunsenson. I'm the director at Stone Family Foundation. We're a UK-based charitable foundation that acts as an impact investor, and we have a very specific focus. I'll just wait for my slides to appear, hopefully. Yeah, if you just move on one. Yeah, we were established in 2005 by the Stone family following the sale of a family business. And in those early years, they took advice from NPC to build up a learning portfolio from which the foundation has gradually focused its giving. I always think about the foundation's journey in sort of 5-year blocks, and we're just actually entering another 5-year block where we've really focused down on what the foundation is focused on. And since 2015, which is when I came on board as the first employee of the foundation, and picking up from Gail's point earlier about how you staff these things, the foundation decided in 2015 to recruit a team to lead its international work, which is predominantly the portfolio that I lead, and is focused on water and sanitation, and in particular, the private sector, the role market-based solutions, the role enterprises play in delivering better services to people in the developing world. And we also have 2 UK portfolios, one which is focused on mental health and one on youth. And since 2015, we have significantly expanded our impact investment work, and we now have a portfolio of $18 million in commitments. When I joined, we had 3 investments, 1 debt, 1 equity, and 1 convertible note, a sort of a form of debt which converts into equity. And they were very much a learning portfolio that the trustees had set up. And we learned an awful lot from those initial investments. The 2 big things that we've done in the last 4 or 5 years, I would say, is we launched the first development impact bond in sanitation, which is focused in Cambodia. And what we're trying to do here is we've provided about $2.5 million of investment, working capital investment, to an operator, to an organization that's delivering a program. And that program is at the moment being very successful. We're 60% on track for the various milestones that we have, and we've unlocked about $6.5 million of outcome funding, with the outcome fund payer being USA, which is the US government's aid agency. We also established a local bank guarantee mechanism in Cambodia. And so here we are essentially providing a guarantee to a local bank to provide investment to private water operators. And the scale again is about $10 million. We've made 27 investments, and we have 25 operators or partners there. So if you'd like to move on from one slide. So why did we do it? Why have we focused in on impact investment? And to put it really simply, there is a very big need in the sector where we work. We're really clear on why we do it, and we're able to. Our sector is chronically underfunded. There's some crazy stat which says, I think we need $114 billion to achieve the Sustainable Development Goals, which is a crazy amount of money. And so the reality is, if we're going to achieve or get close to the Sustainable Development Goals for water and sanitation, some of that capital needs to be private. But the challenge is impact investment in our sector is not yet mainstream. There are a lack of proof points. It is a very risky sector into which to try and deliver these types of models. And so there's a very high perception of risk. But as a foundation, that's what we believe our role to be, is to take that risk and to really demonstrate the art of the possible to other impact investors, to DFIs, to foundations, to try and draw in capital from outside the sector. This isn't about sort of hoovering up capital that exists in the sector and sort of repurposing it into more complicated vehicles. This is about trying to show people how you can achieve your specific goals, but also deliver a lot of social impact. We're fortunate in that we have a lot of deep sector knowledge that we can capitalize on, and that helps us navigate and develop things where which are more innovative, let's say. And we can also really balance the financial return with the social impact delivered. At the moment, the investments that we have done are almost all PRIs. There is one mixed motive investment that we've done, but actually the endowment has done that. And I guess that's the other thing to note, is that we run off an endowment which is invested for financial return primarily, but has a very positive impact lens applied to it. But once the funds come into the foundation, we're there to deliver social impact. And so that's the mandate that we have, and we can approach that as flexibly as we like. I think we see our role really being to demonstrate, to advocate, and try and replicate. As I said earlier, what we're trying to do is bring more finance in and play the role of being catalytic, whether that's being concessionary on some of the finance we develop, or doing things ourselves because we have the resources to do it, but then using that as a platform through which to try and encourage others to do similar. And as Gurmeet said at the beginning, really enables us to recycle what are actually, ultimately limited funds to deliver more social impact. And that's a key driver for us. So just to give you a sense, one of the reasons we've done, we're able to do it as well, speaks to one of the points Gurmeet said earlier around income generation. We are investing in organizations, businesses that are trying to generate revenue, because that addresses a key challenge we see in our sector, which is financial and operational sustainability. It gives, by investing, it gives us a better lens into the business. It gives us more information and a better understanding of what's happening. And at the same time, it applies a different level of rigor to those organizations, with the goal being that they are financially sustainable, they are operationally sustainable into the future. At the moment, we're probably doing about 50% of our sort of disbursements, if you like. If you think about disbursements on an annual basis, about 50% is in grants and 50% is in impact investment. And we're really clear when we talk about investment, why we're doing it. Why is that the right type of capital for this organization at this point in time? And sometimes we'll provide organizations with grants to make them investable, if you like. We'll fund a business plan to try and get it to the point where we might then step in as an impact investor in the future. If you flip on to my last slide, what have we learned by doing it? I think, the key rationale for us is like, why? Why would you do it? Why would you go through all of the additional complexity, all of the key challenges? And if you're not clear on that, then you're not really sure what you're doing, I don't think. And so, as a foundation, you can deploy capital in many different forms, and choosing the right one to solve the problem you're trying to solve is absolutely critical. And that's something that we talk about a lot. Why? Definitely get some advice and be strategic. We, after a couple of years of doing some impact investment at a much lower level, we developed an impact investment strategy. We took legal advice, and we worked with an experienced investment analyst to help us design some of the first structures that we did. It's also important to be clear on the compliance points. Gail talked a little bit about, and I think Gurmeet did as well, about the Charity Commission's guidance on this, and that was partly the legal advice that we took. And so we're clear where we sit on that spectrum of finance and what we can and can't do. And also all of the things that you have to build into things like governance and the decision-making process and how you document that. That's really quite important. You have to make sure you're very clear what was taken into account when the decision was being made and how the return is being generated and by who. There's a lot of value in developing a learning portfolio, we believe, and to test ideas and ultimately kind of make mistakes, if you like. Although, and then to extract the learning from that, I think is really very important. If you can be flexible, do, because I think that opens the door to many more opportunities. Be knowledgeable, be open to learning and going on a journey of learning with organizations. And I think the last thing is probably quite critical. You really do need to balance the desired financial return with the social impact that's being delivered, and really understand that, because there is likely a trade-off. Certainly in the sector we work in, this isn't a sector where you're going to make 15% returns in 4 years. This is a sector you have to be patient in. This is a sector you have to be flexible in. But if you can do those things, you will generate enough return to make it an attractive proposition and a worthwhile journey to go on, but also have huge social impact. So I'll leave it there.
Thank you, Paul. That was fantastic, and it's really great to sort of hear of your experiences, not just from strategic perspective, but also from operational perspective, and sort of how you had to build in specific structures and get other advice to be able to do impact investing, or more specifically PRI investing. And you talked about this great example where the foundation unlocked and leveraged funding from local banks in Cambodia, who I know from experience will never lend to water and sanitation sector because they would always consider it really risky. So it's really interesting of your experience of actually getting them to lend alongside. And that's such a great example of how one can leverage capital, which would otherwise never come into some of these sectors which foundations prioritize to have an impact in. Maybe to kick off our question and answers, I wanted to maybe put a question to Gail, which I'm hoping will also be useful to many of our attendees. Gail, we've talked about this earlier, and it'll be good to hear from you about your experience from speaking to many foundations on the biggest barriers which the foundations have typically faced when they've thought about doing impact investing. Impact investing is a buzzword today, and there's a lot of pressure on charities, funders to consider it. But at the same time, as Paul said and you said, it is operationally complex to go about it. But it'll be good to hear from you on what are some of the specific barriers you've heard people talk about, which others in the network should think of.
Yeah, absolutely. I think a few years ago, people would have said, you were venturing into the unknown. There are now enough foundations doing this, that there are people you can crib from and people you can get help and assistance from, which is great. And people have been really open and generous at sharing what they've done. As we've all mentioned, I think program-related investment, particularly if you're doing it from your endowment, so you're making a carve out of your endowment and saying we're going to take a pot of that money and use it towards program-related investment, you do need to take some legal advice at that point. You will need a different investment policy for that pot that takes into account the type of investments you'll be doing, the type of returns you might be willing to take, and how it will relate to your mission and so on, and making sure all of that is documented. Obviously, if you're doing it out of a grant making pot, then that's slightly different. You will also need to take some accountancy advice and speak to your auditor, because it is an emerging field. We do now have accountants who get it, which is great. But yeah, we had a few scared auditors back sort of 5-10 years ago going, well, what do you mean there's money going to be coming back? How do we account for that? And so those type of kind of hurdles, I think, can be got over by just sharing with other foundations how they've been doing it. I think two of the other hurdles we do see a lot, one can be around trustees, and particularly trustees feeling that their job is to maintain the value of the foundation and to make returns and then to use that money for grant making. And it is a mindset shift. And so there is a journey that trustees and potentially staff will need to go on to really think about what impact investing means. You can get good returns from impact investing, but it is much higher risk than, a typical diversified portfolio. And so trustees need to get comfortable with that. And we have seen some really interesting discussions among our members about perpetuity. And what does perpetuity mean? Does it actually mean you're looking at a 20-year time horizon? And therefore, what would you look for in that versus a 50-year, 100-year, and so on? Because people get kind of hooked on the perpetuity train. So it's definitely worth thinking about that, and particularly in the context of climate change and some of the other crises that are going on at the moment, about how much urgency there is about some of this. And then the final barrier, I would say, is just words, just being really clear among your trustees, among your staff, about what you're talking about when you're talking about mixed motive investing, or when you're talking about program related investing, and generally when you're talking about impact investing. As we said, it is a buzzword at the moment. Every mainstream investment manager will be saying to you, oh, we know how to do impact, we can talk to you about impact. And so it's really understanding what the additionality is of what they're doing. Is it just responsible investment, or is there some additionality that makes it an impact investment? And also just making sure you're really clear about what kind of impacts you as a foundation want to be having before you go out to talk to investment managers, particularly around that mixed motive piece.
Thank you, Gail. That was really interesting. And again, you touched on some of the themes Paul was talking about being very clear on why you want to make investments and what role they play in sort of your overall portfolio alongside grants. One of the questions I had for you, Paul, was really to sort of maybe think about your investment advisors who manage the endowment, and what role did they play, if any at all, in sort of guiding the foundation's PRI investments in terms of either bringing some investment expertise or just sort of helping you draft the framework on how to think about PRIs alongside mixed motives?
Yeah, it's a good question. Less so. They are aware of the investments we make, and we keep them up to date, and they're very interested. And actually, we often have conversations with them about opportunities which may sit better with the endowment or may sit better with the foundation. And certainly we did one investment as a mixed motive through the endowment when it made much more sense for them to do it. I think as I say, the endowment has a sort of positive impact screening on it, but clearly it's designed to generate also financial returns for the foundation. So less so, but what we did is, we worked with, one of the law firms, a larger law firm that has a specific social impact investment team to give us the advice on, and particularly on how to navigate the Charity Commission's guidance, which is clear-ish, but not absolute, I would say, and so open to interpretation. And I think that's the key challenge, and that's why their advice was to make sure that we had documented the whole process, and also that the decision and the things that the trustees discussed and the things that we took to the board were very clearly documented, so that if there was any sort of review post the event, then we could justify why we made the decision that we did. One of the key challenges is around when you're investing in a business that's essentially private in nature, and how does that return get generated, and is that return for private benefit, as it were, and so navigating that can be quite tricky. It's a sort of an extra hurdle, an extra step, but I think there's definitely ways in which you can do that, so long as you're clear that the social impact is there and baked into their mission. So.
Thanks, Paul. We have a question for you, which is more about understanding the experience of setting the impact bond. Who were the partners and how was the process from the foundation's perspective, and
Sure.
And maybe lessons from that.
So the first thing I would say is it's all documented on our website. So there's a video that explains it, and also there's a couple of publications there that explain like how we set it up, but also the learnings that we've had since then. But yes, we approached one of our partners, IDE, who are a US-based organization. They had a very successful program, but it was needing to pivot and sort of reinvent itself in order to achieve a specific social impact that we believed in and we valued, and so did they. And I think that's the key with these things, with impact bonds. I mean, it's an unfortunate name because it's not really a bond, it's just a sort of payment by result structure. But we were all very clear that we all valued the metric that drives the model, basically. So essentially what we've done is we've provided IDE with working capital. They are to invest in their program. Their program is designed to deliver a certain outcome. And USA, the US government's aid agency, values that outcome enough to pay a sort of a price per metric or a price per milestone. And so once that's generated, funds get recycled back through, and the model becomes a little bit sort of virtuous. And at the end of next year, we will get all of our capital back plus a return, which actually we're splitting with the implementing partner, because we think that's a fair sort of allocation of resources, if you like. So it was, I think, it's that point I said earlier, we were really clear why we were going to do it. And that was the question. So we worked with social finance, who are sort of the big impact bond leaders. And the first question we asked them was, does this program have the elements of the payment by result structure? And if it does, would a DIB be the right structure? And we were very prepared for the answer to be no, and for us to then walk away and have another think about what we might do. It just so happened that the answer was yes, and then we sort of moved it forward like that. But we were really clear why we were doing it, and also, and we all aligned around the metric, and we all valued that metric enough to, invest the time and energy in it. Now, the final thing I would say very quickly is it's a very simple structure. You hear a lot of horror stories around development impact bonds internationally, where you have 3 or 4 investors, 3 or 4 outcome funders. What happens then is the transaction costs become very high and very complicated, and the negotiation becomes very complicated. But in this bond, we have 1 investor, which is us, we have 1 implementer, which is ITE, and 1 outcome payer, which is USAID. And so there's a sort of beauty and simplicity, we feel, and so therefore the transaction costs have been relatively low. And that means more capital can go towards delivering the social impact that you're trying to achieve, which for us was the big sort of tick, if you like. So, but happy to pick up conversations offline if you want to reach out, but also do check out our website. There's a little bit of information there, and a nice video which kind of explains the structure and why we did it.
Thanks, Paul. And if you want to post the link to the video or the publication in the chat, please feel free to do so. But that's such an interesting example of really trialing something very high risk in a sector which needs risk taking. And it's really good to hear that you had positive experiences with impact bonds. We have a question around understanding the role of advisors on impact investing and whether there is a need for education there. I think this is somewhat related to what I was asking Paul earlier about, what role their endowment manager did, because in our experience, we felt that advisors are typically quite wary of impact investing because they see this as this new frontier where one is taking unmeasured risks with endowment investing, and that can be quite scary for fund managers who are really, really highly focused on generating market rate returns. But it'll be good to hear from you, Gail, how you have tried to engage with the advisors as an industry group and if there are any sort of learnings from that.
Yeah, sure. And I'll take the other part as well about the generational difference, because we've definitely seen a shift in family foundations as younger generations come in. And just generally, as boards have been diversifying, a lot of the agenda around diversity, equity, and inclusion that we're now starting to see bear fruit in terms of younger, more diverse boards. I think there's been some really interesting conversations about what is the purpose of an endowment? What does perpetuity mean? What does the climate crisis mean? And also, how can we bring our investments and our grants closer together? And so some of those really big questions are being asked. The main thing I would say with investment advisors, and we are seeing upskilling both among philanthropic advisors and obviously investment managers, investment advisors in a financial sense. The main thing that ACF and SIG always emphasize to foundations is it is your money. So there's this tendency to say, oh, our investment manager says we shouldn't do that. You say, no, rewind. It's your money. How do you want to have impact as a foundation? How do you want to make the impact you want to have? Now, it may be that you say, we want a responsible or sustainable investment strategy and then to spend those returns on grant making. That's perfectly fine, as long as you're going into that consciously, rather than just doing that because that's what your investment manager tells you to do. We are seeing a growth of upskilling among mainstream investment managers and advisors around the mixed motive piece. Clearly, the program related piece where you're making concessionary or 0% returns is not going to be of interest to mainstream investment managers, and that's perfectly understandable. But for example, Guy's and St Thomas's Foundation, Esme Fairburn Foundation, they are working with their mainstream investment advisors to say, this is what we want to do. We'd like you to work on this with us. We'd like you to upskill. And they see that as part of their role as larger foundations to help the investment managers and advisors to kind of upskill in this area and make it work. And I think mainly just a really open and honest conversation with your investment manager. I was with one of the large investment managers last week and they were saying, these are the impact plays we've made. This is what we're doing. There is not a huge amount of mixed motive investments available at the moment. And so it's having those really honest and clear conversations with your investment managers are really important.
Thanks for that, Gail. And I think there is something to be said about the fact that mixed motive investments are quite limited. And also there are much fewer indirect investment opportunities than I think a lot of foundations would like, because direct investing, as we've talked earlier, is higher risk and is more involved. And I think there is a natural inclination to go towards indirect investing, but the opportunities seem to be quite specific in certain sectors, especially within the UK. And I think there's a bit of a mismatch of demand and supply there. I think we're now coming to the close of the hour, and I would close the session now by thanking our fantastic speakers for sharing their lessons with us, talking about their work, but also answering some of the questions. Please feel free to reach out to us at NPC if you have any further thoughts. You can reach out to me, you can reach out to my colleague David, who is a part of the impact investing team, and will be happy to answer questions. We also have our annual conference coming up, NPC Ignites, on the 11th and 13th of October. So feel free to click at the link and get the tickets. Otherwise, it's been fantastic to have all of you, and I hope we've got you to at least start thinking about impact investing in a more serious way than you have. But please feel free to get back to any of us if you would like to chat further. We would love that. Thank you so much. Bye-bye.
Thank you.
Thanks, Gail. Thanks, Paul.
Thank you. Thanks.
Thanks.